get all the legal stuff out of the way, and we'll be good to go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker and registered investment advisor before placing any trade. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither ForStockWorld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying a guarantee of any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified day. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. Let's see. How are we looking? We are looking very flat at the moment. Everything's flatty. Okay. That's good. Oil back down by 52, but it seems to be holding this line as your support 1 line. And gasoline, though, is falling to support 2. And I thought oil was going to do the same and break through this time, but it didn't. Now, it's so violent to play. This is a new contract. What's the old contract? This is H, so the last one was G. All right, there you go. So here's the last one we played, and that did we had 10 contracts. They did 75.50 today. That's since the open here, and we made a bid over here too. So we did very well in the end after all that from last week. But these are violent moves. I mean, that's why when it went down here, we took the money and gave up. We took the money and said, fine, that's enough. And we skipped all this in between. Some people were playing it. I did call along this morning on the, I called along on the new contract. Very confusing. All right. So on the new contract, I called along off the 52.50 line. It didn't do well at first. Then it went up. Then it went down. Then it did super good. And, when you make $500 for these bounces, that's all on a bounce play, that's all you want to make. That's fine. In fact, frankly, 53 was a good spot to go short again, of course, because that's where we started going short before we had the spike up where we added more position. There's no particular catalyst right now because, as I pointed out in the Morning Post, they drastically, and that's at the beginning of today's session, they have drastically lowered the amount of open contracts. So as a rule of thumb, we figure they can do 35,000 contracts a day without a problem. 35,000 contracts a day, not a problem. So they have Wednesday, Thursday, Friday, and Monday to do 120. It's only 30,000, and plus they're not going to get rid of every single contract. There'll be 15,000 left or something. So they really only need to get rid of 110,000 contracts. That's not a problem in 3 days. So there's no big pressure. See, you get this one play per month. At the end of the month, when you get near the contract expiration, if there's a large amount of contracts remaining, if there's more than like 40, 45 a day left, that's when you want to play. Once they get back to like 35,000 or less per day contracts left to roll, there's no more, that's all we're doing is playing that one time for the big pressure where they have to dump contracts. But once they dump the contract, you can't just keep betting it's going to go down. Even though, on the whole, oil should go down, but there's no particular reason to go kooky and try playing the futures, because then this is what you get. Then this up and down insane action is what you get when you're trying to play. And that's no fun. I like to play with conviction. I like to play here, and if it goes higher, I short more, and then when we get our big sell-off, I cash in, and I'm done. And that's it. Move on to the next play by playing 1350 long on the Russell into the close. That's practically a no-brainer, right? I mean, it's first of all, it's a good line because if the line fails, you get out, and if the line doesn't fail, it's a good play. Now, I don't have it right now, so it's going out. We've got possibly the 155 line. You can play for gasoline going into the weekend. That's a good play. We already talked about shorting the Nasdaq this morning, but you got a 10-point drop. 10-point drop is good on the Nasdaq. That's about all. You can't play these things looking for huge gains. I know we get huge gains sometimes, but that's kind of an accident. You get $500, you get out. End of story. Because any little bit of news, any report, anything that happens can change things. Look at natural gas got a nice sell-off. Look at that, huge, from 50 all the way back to 330. That's a massive sell-off in natural gas. But February is like the worst month for natural gas. So, because you've got the end of winter, and winter's ending fast right now. And, in fact, I say these things and I forget to go back and talk about it. Let's just go back and do it. So we go to AccuWeather. Very easy to check these things. AccuWeather. And we go to AccuWeather.com. And we go to Radar and Maps. And we go to Forecast Maps. And we go to Trends. And this is going to show you what the trend is. Now, look at this. Hot, hot, hot. Hot, hot, hot. That's 6 to 10 days of hot, hot, hot. Okay? It's colder in the west, but really the big money for heating is over here. This is where the big money heating days come. Dense population, old-style houses, not energy efficient, and they use a lot of natural gas to heat. 11 to 15 compared to normal, it averages out. That's because it was very, very cold. Now it's getting warm. So the average is actually still cold. But it doesn't mean that it suddenly gets cold. 30-day compared to normal is basically normal. And 90 days compared to normal is basically normal, except for up here in the hinterlands. But when you look at these maps, nobody lives here. Who cares if they have to heat their homes? Okay, and these people live underground in tunnels. They are tunnel people in Michigan. They don't live above ground. So it's not a big deal. Okay, obviously hot in Florida doesn't matter. Nobody cares. Hot here doesn't matter either. What matters is what's normal. So for the next 30 days, basically the 30-day outlook from now till 30 days is pretty much normal. Not particularly hot or cold. And what we're not seeing, though, is this. This is what you want to see in a long-term map to be gung-ho bullish on natural gas. And even this, so you're getting below normal in Florida isn't necessarily deadly, right? So it depends where you're below normal. You want to be below normal in populated states. So you want to see this blue over here, where all the people live. All right, so keep that in mind, and the bottom line is that there's no particular onus for natural gas to go up, and hopefully it'll drift back down, and we'll get another chance to play it long. You don't want things to always go up, otherwise we only play them one time and then we never see them again. It's funny because it doesn't look like much, does it? I mean, here's today, 350 to 330. It only looks like that little candle there. This isn't even signed in by me. It is signed in by me. Why does it not have an update? All right, anyway, so obviously the 50-day moving average here is like 327, so you want to play off of that. That's probably going to hold. We are in a long-term uptrend, but we could go to the 200-day moving average is way down at $3. It's not even $3. It's actually $2.87. And here it's, in fact, here the 200-day is $2.78, and here this is 40 weeks. Not quite the same as 200 days. It's $2.87 or $2.78. So basically, you're under $2.90. That's your takeaway from this. So $2.90 is the real bottom that we could fall to. And here, in fact, here you can see this coming up on the 200-day moving average. So Just because we think 330 is going to hold doesn't mean it will hold. If something goes wrong, it can go over to 290. Here's what you got to worry about in natural gas. This happens a lot in the beginning of the year. It happened here too. Even though gas prices went real low, you come into here and they go even lower, like another, what is that, 80 cents? So 80 cents 80 cents into 330. It's 25, went 25% lower after a huge dive. So there is no bottom. There's no looking at this and saying, oh my God, we got such a discount, we should jump in. It can go much, much, much lower. Look at this one. So you got $2.49, you come down to $2, and you say, wow, $2, that's great. Then it goes up a little bit, and same exact thing people are doing now. Goes up a little bit into January, and you say, oh wow, okay, this is time to catch it. It's going to go to the moon, and all of a sudden, bam. That's 90 cents out of 250. It's like 30% drop. That's what normally happens in the spring with natural gas because it's not cold anymore, but it's not warm enough to do air conditioning, and the pools aren't even coming in. This kind of spike is what you get when people start opening up their swimming pools. It takes a lot of gas to heat those swimming pools. So you get that kind of thing when swimming pool season starts up. But then there's a lull in demand, and then you get into the summer with air conditioning season. We have long, hot summers now. So those are good for natural gas. So that we can kind of count on. But now it's just, unfortunately, it's too early to get in. I'm not saying, and again, we're not getting out of our long-term trades because long-term we believe in this trend line. But in the short term, no, I'm not really interested in getting long until we get back around $3. I'd love to see $3. Maybe at 330 I'll take a poke, but only if it holds that line. Otherwise, I don't want it. All right. Let's see, questions or anything like that. Hello. Anybody having problems with calling in? Now he's got it. Hey. Okay. You guess that? Okay. Well, that's good. Sound too low. I don't know if there's any way to fix that. Oh, wait, there's a mic thing. Huh. Does that make me louder? Anybody? No? Okay, yeah, I didn't think that had any effect. Good? He says good. All right, well, I'll leave it over there. If it has no effect, then why change it? All right. That's no fun. Uh-oh, I don't know about that. It's not this kind of chat room. How about detail walkthrough PG rolling the butterfly portfolio? They can turn up their volume. Yeah, that's true. You probably do have volume adjustments on your machine. All right. How about a detail? Look at these special requests. Yes, I will detail to you one trade out of the portfolio. I doubt it. These are always disappointing to me. Let's take a look. Butterfly portfolio. PG. All right. We sold the 85 calls, and we sold the 80 puts, and we're geniuses because they're both going to, I knew it was going to be nothing. So they're both going to expire worthless, or more or less, anyway, right at 85. So they're both essentially going to expire worthless. I can't believe these are still 95 cents. They must have earnings. When's PG earnings? Yahoo. PG. If they don't have earnings, I don't understand why the calls will be so expensive. Earnings 20th. Haha. See? I know my stuff. You guys think I'm just a joker here, but I know these. All right. So the reason that these calls are still 94 cents is because PG has earnings on the 20th, which is Trump's inauguration day. And I would be inclined, frankly, to take that money off the table beforehand because you're not getting paid enough to take the risk. Even though it's still a buck left, and I hate to take anything off with a buck early, because you're right on the nose. It's, we're at 95, so if PG goes up 2%, which would be $1.60, then this thing will cost us money. So why would I want to risk that when I don't have to? Now instead, so effectively you take them both off the table for $1. That means we sold them for $5.45, so we're going to make $4.45 by paying $1 to take them off the table. So that's it. We're done with this month. Now, do we want to, here's the question, do we want to immediately resell or do we want to wait for earnings? So then we go here and we say PG. And they're kind of right in the middle of their range, which is when we sold it. When did we sell these? So when we sold these back in July, way back in July, we decided, so here, we decided to sell the 85 calls and the 80 puts. And boy, was that great. What a great sale. Okay. But we made a 6-month sale back in July because the intermediate premium. And the reason why, because I thought this would be the range. You see what happened? We went $4 over, and then we went $4. We went $4 under. We actually nailed the range. Selecting $5 means we profit between 90 and 80. So this was the actual range. Now, that's the whole point of long-term portfolio, though. We don't care. We didn't care when it was here. We didn't care when it was here. You just wait and see how it works out, and look what happened. It turned out to work out exactly perfectly for us. You're not trying to outguess things. It's like when you're it's like if you buy a house to rent it, right? And you rent it, and the rent's going to cover your mortgage and make you like a tiny profit. Well, you don't go every time you think you can get a better tenant or make some more money. You don't go kicking out the tenant you have because the next guy promised to pay more for a month or something like that. And if you can get a little bit less, you don't take a longer term lease because you're worried about that. You just rent your apartment out for what it gets at the time. And then because as long as you're covering your mortgage, you're happy, right? That's all this is. We just want to collect our rents. And as long as we feel comfortable that it's going to cover our range, we're going to be happy because we know we're going to make the premium no matter what. Even if it goes outside of our range, we're still making our premium. And in this particular case, on the P&Gs, we only paid $8 for the 2018 puts and calls. So we paid $8. They're still worth $6. So we paid $8.50, and they're still worth about $6. So they bought $2.50 in value, and we bought these ages and ages ago. So this is not the first time we sold these. But in this cycle right here, we're collecting $5 against an $8 outside thing. That's 40%, 60, like 60% of the money in one cycle. That's all we need to do. You make one more sale like that, and everything else is profit. Now, with PG, though, see, some of these, this rolling period, by the way, maybe not this particular week. I want to concentrate on the rolls that we have to make. But in the near future, we're going to have to start rolling out some of our 2018s if we want to keep the position. Because we don't really want to be in 2018 puts and calls. We want to move out to 2019 if we're going to stick with these positions. So it's going to be time to invest a little bit more money in longer-term positions. But anyway, okay, so for PG. So now the next thing we sell on PG is the next thing that's going to pay us about $5 because that's obviously the trading range. So PG. And we already know that we're going to have to look out a bit because the nature of it, March. And then you always look at the money. March 85, pay $4, not so bad. Now the question is it going to be worth going to June? Do I get enough more money for June? $350 and 3 is $650. So for March, which is 58 days, we get $4, not even $4, but a bit less. But then for June, which is 150 days, 3 times more money, we only get $6. So we're getting 50% more money for 200% more time. Not worth it. Okay, so let's instead, I would say, I think 85 is the right price, so let's instead just sell the 85 puts and calls here. So that's what we'd want to do, is roll the 85 puts and calls. We put another $4 in our pocket, and then we wait and see what happens. That's it. Very anticlimactic because nothing really goes on. It's not that complicated. Oh, for God's sake. Oh, so let the phone. I usually take the phones out. Can't eat those. All right. Where are we? I mean, I suppose I couldn't even if I read some instructions or something, but I can't. All right. So moving on. Bum, bum, bum. It's not a big deal to roll something in the butterfly portfolio. Volume, PG, good for a new play. Is PG good for a new play? Yes, I would say it is. But, obviously you want to take the 2019. April is about 5. Yeah, and again, another month. I think I'm happy with $4. The $4 in March. And I just like quarterly better. Plus earnings will, in April, you might hit earnings again, and in March you won't hit earnings again because they're just having them right now. So that's another good reason. Now, so if I was going to do a new play on PG, knowing what our range is, you want to cover like the $90 calls in 2019. They're $4.50 basically, and you want to cover the $80 puts. Ooh, I wouldn't do that. No. Well, we don't really think PG is going to go down much, so I do the $75 puts, which are about $525, $535 here. So for $535, you can do the 75 calls as a long, and the $90 call. See, because we think generally it might go up. We're more worried about it going up. I'd rather have the $90 calls, which are tighter. Those are $425. So $425 and $525 is $950. So $950 for your longs. And so if you look at it that way, if you do new play, you do $950 for your 2 longs, and then you're selling the March. So don't forget you have 8 quarters to sell, or 7 quarters to sell, starting from there. You have 7 quarters to sell, and in your first quarter, you're selling almost $4 out of a $9 purchase in premium. So if you multiply that by 7, you have $28 worth of premium that you can expect to sell over the course of 2 years against your $9 purchase. You don't have to be right that much of the time to make some good money when you're going to collect $28. Sometimes you'll be wrong. Sometimes you'll have to pay $5 instead of collecting. But you're going to collect total $28 in premium. That's almost a fact. So if you're going to collect $28 in premium, the only difference is in each quarter, how much money do you have to pull out of your pocket? Now, in this particular quarter, we're pulling $1 out of our pocket, right? Because we're giving $1 back out of what we collected, although our collection is higher than we anticipated. But either way, the point being, though, that consistently out of the $28 we assumed we were going to collect, this quarter we're giving back $1. Now, if every quarter we give back $1, then we're giving back $8 over 2 years, and that means we net $21 back. That's a nice profit, right? That's all this stuff is. It's just math, okay? It's same thing goes for the rents, right? When you're collecting your rents in your apartment, you've got a mortgage and all your mortgage and fees and costs. Let's say $2,000 a month, right? So if you get a renter in there for $3,000 a month, you're going to make $12,000. Now, out of that $12,000, maybe the toilet blows up, or maybe the refrigerator goes, or maybe you need a new stove. You know how stuff is. So maybe you have some replacement costs. At some point, you have to plan that you're going to need to paint the place. At some point, you have to plan for some other stuff. But hopefully, you have good tenants. They don't abuse your stuff, and everything works out, and you net most of the $12,000 as your profit. Most of that excess $1,000 a month is your profit while they're leasing the place. That's how it works. That's all this is. It's not much different than owning real estate, except we have faster turnover, and also we can in a very low market we may elect to wait because we have less of a penalty for leaving our apartment empty. If you're a landlord, leaving your apartment empty is kind of a stupid gamble almost any time. So it's never a good idea to wait for the market to turn around when you're renting an apartment. But in our case, yes, if we have a sharp correction in the market and we decide it's too low, which we've done several times in this portfolio, then we say, okay, you know what? We're not going to sell any calls this month. We're going to wait and see if the market corrects. We can always get back to our call selling program. Again, that's also a part of it. If I know I'm going to collect $28 over the course of 2 years, right? And this month I decide not to sell the 85 calls for $2. Not this month, this quarter. What am I really risking? I'm still selling the puts because I think the market's bottoming. And I'm not saying on this thing, I'm saying as an example. So I'm still selling the puts because I think the market's bottoming. So out of my $28, I've sacrificed $2. That's all I've done. I've taken that much risk, 2 out of 28 risk, because I think the market will go up, and my intention is I will sell a $3 call later. That's all. That's the only risk I'm taking. And maybe if I'm wrong, I end up selling a dollar call. I'm not even really risking the whole $2. I'm just taking the opportunity to make a decision now. So those are the decisions we make along the way. And if you guys go back and you look at the old portfolio adjustments, you'll see all that stuff. I write this stuff down in the logic. If you go to the the virtual portfolio tab on Phil Stockworld, and if you go back and you read these trade reviews, okay, we discuss this stuff all the time. It's written right there. So if you want to learn something, go back and look at the logic we had when we did stuff. Wait, is it review? No, that's the top trade review. Silly me. Okay, let's try that again. September portfolio review. Okay. So sometimes I stop and talk about stuff. Butterfly portfolio. Here you go. Walmart. We're expecting a pullback to get us on track, but still profitable. We may as well pay a nickel to buy back the short puts, as anything can happen in 3 weeks and risk miles more than 75. And here, Apple, what do we have here? We have an artificial blah, 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 you know. Text them once in a while. Let's cash our long 55 calls, and that will leave us short, and there's no need to buy it back, and they should go worthless. So I'm writing my logic down, and you can read it month by month by month and follow the trade. So if you want to learn something, instead of waiting a month and seeing something happen one time, go back a year and look at what we actually did over the course of a year while these stocks jumped up and down. And you'll see what the decision process was and how we got to them on all these trades. It's not rocket science. It's just really a question of practice and repetition and getting used to the ups and downs, and also learning to ignore the nonsense in the market. Okay, that's a very important, very tough part to do, is to learn to ignore all the up and down nonsense. If you believe in, and we have this discussion all the time, right? If you really believe and understand the value of the things that you're trading, then you're not fooled by the price of the things that you're trading. Okay, like in member chat, there's J-Bob today cursing out all these stocks that basically every stock he's cursing out is a great value. He doesn't like stocks that go down. If a stock goes down, he starts cursing out the stock as if there's something wrong with the stock. There's nothing wrong with the stock. There's something wrong with the price of the stock. It's actually a better opportunity. You can't be so short-sighted that just because something gets cheaper in price that you decide it's a bad stock. If that's your case, you shouldn't be investing. If your faith in a stock is only as good as the price of the stock that day, you're not an investor. You're a trader, and you're not even a trader because you don't know why you're in them. Like PSO today, Pearson. Pearson took a huge dive today, 28%, big downgrade, blah 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 blah. But this has been a known thing for them all year long. And the reality is, sales are for 2016. Sales are 18% below where they were in 2015. For the entire year, they said this would happen last year. That's why we got off to such a crappy start in 2016. We thought it was baked in, but the reality of them reporting their 2016 sales has just kicked in. And their guidance for 2017 doesn't say, oh, we're going to go right back up. It says, no, this is pretty much it for now. And people sold off again. And they're worried about the dividend going down, so they're selling off again. But the stock itself, they're making over $1 per share. And the shares are trading at 7. Because nobody cares. Nobody cares about the value of a stock. Nobody cares if it's a company that actually makes money. They only care about is the price of the stock improving. Whereas I'm saying, okay, even if they cut the dividend, which is currently 40 cents a share, that's like, at the moment, that's like a 20% dividend the way they've got it structured. Even if they cut the dividend to 20, that's 10 cents. What's the difference at this point? So even if they cut the dividend to 10 cents, they're a stock that's making money. They're selling off a division. They'll bring in some cash. They're going to reorganize and do whatever, okay? If you trust management, that's great. If you don't trust management, then get out. But the business they have left does well, makes a lot of money. Smaller than it was. It's not coming back, but it's steady. So it's a good company in a vacuum, but not compared to where it was. But if you stick it out, what do you know? You know you have a company that you're paying $7 a share for. That makes $1 per share. So if in some way things improve a little bit, it would be very easy to see them going up to a PE of 10, which is $10 a share, which is 50% higher than where it is now. You know the company historically likes to pay a dividend. So even though they may decrease the dividend now because they're storing up cash, down the road, when they start making money again, if they start making money again, they will probably raise the dividend, and people will come flying into the stock. So if you're a long-term investor, there's no reason to get out of this stuff. Just because the price went down, because people were disappointed, doesn't mean it's a bad stock. It just means it's out of favor. So, and again, I don't love Pearson. I'm not happy with the way the management doesn't seem to really have a particular plan for what they're going to do. They say they're going to sell off they have a 47% stake in Penguin Publishing, and they say it's time to sell that because they think they'll get like $1 billion for that. And if they get $1 billion for that, then they want to put it into, they think the solution is more digitization of the stuff they have now, their educational books and stuff. Maybe they're right. I mean, they seem to be very fixated on it, so I think that's what they see as the market. So do we invest in them? Do we keep them for and invest in the future? Now, given they're in the long-term portfolio, and we only have long-term portfolio. Given they're in the long-term portfolio, and we only have, where are they? Oh, here we go. They pay dividends. Okay, so here's Pearson. They're in the dividend section. We only have 1,000 shares. That's $12,500 worth of stock, plus we offset that with some puts and calls. We're going to get assigned, or theoretically we'll be assigned another, these at $10. So we'll have 2,000 shares for $25,000. That's a nothing position in the long-term portfolio. It's a $1.2 million portfolio. So it's not like a big position. We're not going to. So rather than take a loss of a couple of $1,000, you know, we're $5,000 behind on our net position at the moment. So rather than take a $5,000 loss, I'd rather stick with it because first of all, we're collecting. If we have 2,000 shares now, if we get assigned, that means we're collecting $900 in dividends. So $1,000 of our money comes back to us just in the form of dividends. Now, if they cut the dividend, then it'll only be $500 or whatever, but we'll find out. But at the moment, $900 comes back to us in the dividend. They just reaffirmed, by the way, that they are paying the full price dividend this quarter. Then they said after that they're going to evaluate it. So going forward, I don't see any reason to sell this. There's not enough good reasons to get rid of this thing. In fact, oddly enough, R.R. Donnelley, was in the same position not too long ago. Take a look at them. And chart. There's no big chart. I guess it is this one. Nope, not working. I hate Yahoo. Seriously? Nothing? I'm going to put that interactive chart. Oh, there you go. RRD. All right. Oh, here. Okay, so here was RRD. And then back in 08, 09, whatever, and back here also, we started playing back here, and we liked them. When they went back down here, we said, well, we're sticking with them, we're buying some more. Same thing. They went from 20-something down to like under 10. But we liked them. We thought the business would be solid and would turn back around, and they were making good money. So we stuck it out. We actually took a bigger position, and now they're not great. They didn't rebound back, but we don't need them to rebound back. We like having a lot of RRD at a low price. We just ended up having more at a cheap price. That's all. But this is years. This is 19. This is 2009. This is 2013. That's 4 years. And here we are 4 more years later, and we still have the freaking thing in our portfolio. We always have RRD in our portfolio because they pay a fantastic dividend, like 10%. Well, let's see. I'll get back to it. You know what they do? They publish the annual reports, the company. Could not be a more boring business. And by the way, and what's the problem with that? The problem is there's been so much M&A that there's probably about 30% less companies than there used to be, public companies. So they have less reports to publish. They've hurt their business. They have to adjust and downsize and so on and so forth, but they're back to where they should be. And dividend-wise, what the hell was that? That was awful. Don't need dividends. Ah, there we are. So they were paying 26. I'm not sure when they dropped to 14, but they were paying 26. That's quarterly. Now they're paying 14 quarterly. Even 14 quarterly is 56 cents. That's 5%. That's a nice dividend, okay? We like stocks like that. R.R. Donnelley dividend analysis, blah, blah, blah. Okay. This says a dividend yield is 14%, payout is 243% compared to the median dividend 240%. This dividend performance might make it a good stock for dividend. In addition, companies relatively good dividend quality. I don't know. I thought they paid more. Maybe they just paid less for the one. I don't know what the story is, frankly. But bottom line is they're good. They've been a good dividend-paying stock. We've been very happy with them. They've been great to own. They were paying something like a 10% dividend historically. I don't know if they've dropped it or if that was a one-time thing. So I have to look into that before we do anything else with them. But the bottom line is we've owned them for so long. It's a free stock for us. We just basically collect the dividend. We've had this thing forever. I know this says 225.16, but we've always had this in our portfolios. Even then, it was only 13.50. So 13.50, less the calls here, and they're well above this. So now we all this will expire worthless in March. So 13.50 minus 150 is 12, minus another dollar is $11. So our net here on this little set is $11. So we'll either get called away at 15 if we decide we're not happy with the way they're handling the dividend, or we'll roll out and we'll stick with it. But that's it. That's a long-term value stock. If the only time you're going to buy a dividend-paying stock is when it's doing well, and when you have no reason to say F you to it, then you're always going to have expensive stocks in your portfolio. The time to buy a stock is when it's cheap. If you want to be a value investor, you have to learn to buy when things are cheap, like Warren Buffett does. For 60 years, this is what he does. He buys a little bit of a stock, and when it goes down in price, he looks it over again and says, okay, I'll buy some more. And then he holds on to it for another 10 years. And he's the richest man. He's one of the richest men on earth because that's all he does. All you guys trying to time your entries and your exits and your getting out and your strategy and blah, 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 it shouldn't be that complicated, okay? Is it a good company? Does it make money? If so, when it's cheap, I want to buy more. When it gets and by the way, knowing when something's cheap, you also have to know when it's expensive. When it's expensive, you want to sell. Okay? Netflix users don't seem to understand this concept. Pull back a little today. So we shorted Netflix. Netflix users don't get this concept, okay? This is the last time we shorted Netflix. This went well for us. And now here we are again. And I don't know what they think is going to happen. I really don't. And I really thought it was a bad sign today because they announced today that they had signed Jerry Seinfeld up to do a show for lots and lots of money. And I don't know how you're supposed to consider that a positive. They're just basically being a TV studio. TV studios have PEs in the low teens. Netflix has a PE of 200. It doesn't make any sense. They're not becoming a .com company. They're a .com company becoming a TV studio. They produce more and more and more content and spend more and more and more of their money on shows. And not all their shows are winners. Have you actually looked at Netflix? There's a lot of bad shows they produce. They talk about the couple of hits they have, but a lot of that content, you see one season hit, one season shows. You know the value of a one season show is nothing. This is why network TV companies trade in the low teens. When you create a show and it turns out not to be a winner and it only has one season, it's just dead weight in your inventory. Nobody's really going to watch it. You don't go back to a 2014 show that ran for one season and go, oh, that's when I want to start getting into. It's not real content. Okay? If dead content was valuable, then Blockbuster would still be around. Blockbuster had tons of movies nobody watched. That's what killed them, really, is their inventory problem. Netflix beat Blockbuster by doing a better job of managing their inventory. They had basically just the popular stuff. They didn't need to fill a store. When in the old days of Netflix, when they first started, they had a sheet, and their sheet that you would get in the mail would show you about 100 movies or 200 movies top, and that would be it. They'd be like, here's 200 movies you can choose from. You go to Blockbuster, there's like 1,000 movies, and the reality is 99% of the customers pick out of the 200, but they pick the top 200 movies. But 1% like the other stuff. But you can't run a store for the 1%. Not that 1%. You can run a store for the 1% if they're rich, but you can't run a store for the 1% when they pay you $10 a month, and you have to stock thousands of movies for them, versus everybody else is paying you $10 a month for the same 200 movies. So Netflix learned that, and that's how they kicked the crap out of Blockbuster. But now they think that they're smart because they're producing content based on what people want. But what they don't understand is what's popular today. And this is why Hollywood people. This is why Hollywood is hard to replace what they do. when you green light a production, which means give it the money to go ahead and start making it, when you green light a production today, because your demographic studies show that people like superhero movies with strong female characters that have Hispanic sidekicks, blah, blah, blah. You know, I mean, this is literally what Netflix does. They say, okay, people like movies with this and that and that and that, and make sure the suit is green and make sure the car is a late model Chevy. You know, I mean, they've got all the little psychological profiles of what people are watching on their screen at any given time. The problem with that is that you greenlight the production today, you start casting it over the next 3-4 months, you start shooting it, and you start scripting it and so on and so forth 6 months. Now you start shooting it over the next year or so, and then 2 years from now it's finally released. People's tastes change very quickly. And the Hollywood people get that, and they're the ones that actually they set the trend. They don't wait for people to say, I want this, I want that. They decide what they think people are going to like in the future, and not based on like computer demographics and crap like that. They make these decisions based on creativity. If there's a book that's big one is obviously if there's a book that's popular. Netflix doesn't ignore this completely. If there's a book that's popular, you start thinking about making a movie about it, and you buy the rights to the book and you see if you can make a script and get a film and blah blah blah. People don't. The movie public doesn't know they want to read. They want to see the Chronicles of a Vampire, whatever you call it, Interview with a Vampire, the Anne Rice stuff. The movie public doesn't know they want to see Harry Potter, not until you show it to them. But the book public knew Harry Potter was hot for years. It just takes so many years to get to screen, but once it's on screen, it's a blockbuster. So the Hollywood people, they know that book people are smart, and book people have imagination, and the book people they're good at getting ahead of the trend. They are the trendsetters, in fact. Netflix is a follower. They're a following company. They're essentially a bad studio, and the growth of the company is masking the fact that they're a bad studio. Bad studios have come and gone for 100 years, and Netflix is acting like a bad studio right now with their 355 PE. Okay? Bad studios with 12 PEs fail. This is a bad studio with a 355 PE. Big disaster waiting to happen. Okay, anyway. Moving on. My cock was almost all down in Florida. Now I'm back. I got it again. So pissed. Okay. Can you explain and summarize the butterfly portfolio and how often? Blah, 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 blah. Okay. The butterfly portfolio, we take a long-term position in a stock, and then we sell short-term puts and calls against the stock, and generally we only make the trades once every month or once every quarter. There you go. Good summary. All right, PG, thanks, perfect. You do it now or after earnings? I would do it after earnings because there's really no advantage to doing it before earnings. Not a big enough advantage to not know where the target should be. So much easier to set a target after you see what the earnings are. Essay editor has removed the image regarding what? Essay editor has removed the image regarding the tweet. Donald Trump and Soot. Idiot. That's funny. I wonder if they're going to do that with every Donald Trump tweet from now on. That'd be funny. Which strike would you sell for Target? Target, what a killer today. CL testing, blah, 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 blah. Okay, so Target, back to the butterfly. CL testing 52, would I go long? I really kind of think it's going to break below 52. I don't think, it was easy to play for the bounce earlier, but now I'm not so sure. We'll get back to that in a minute. All right, Target. Back to butterflies. Okay, well, the baby books. Ha ha ha. Got work to do. All right, so Target. Target is now at 66. We sold the 75 calls and we sold the 65 puts, so it's perfect for us. It's exactly where we want it to be. Oh, wait. No, wait, that's messy. Something's wrong. What did we do? we sold the 17. Okay, so I'm sorry. We sold the 65 puts in 2019. This is so our position in target. It's not. Our target position isn't a normal position, quote, quote, normal, because what we did with target is we were aggressively bullish. We took a bull call spread, the 65, 77.50 bull call spread for about $4. We sold the 65 puts for $9. Wow. So we got a $5 credit on the spread, and then we sell the short puts and calls. In this case, I think last time we bought back the short puts because I thought target was too toppy, and it turned out it was. TGT. It's going to give kids because you go shopping. If you go shopping, you learn stuff. You know, I don't mean adult shopping because adult shopping is different. When you go adult shopping, you kind of generally like go somewhere, buy something, and leave. When you're with kids, they just endlessly browse and they talk about what they buy and they talk about all these different stores they go to and where the best sales are. So, it's like I listen to what their conversations are when I'm at the mall with my kids and their friends, and you learn what's in and out of favor. And they're all big Target people. All the kids around me they love Target, but they really they're more and more getting into the brains of the mall stores because the mall stores, when they're discounting, have come down. The kids are actually very sensitive to Target pricing, and so. And when you look at the kids, they're like consumers, right? Because the consumers have a limited amount of money and they're sensitive to pricing. So the kids are looking at the prices and they're very sensitive to the fact that the malls, with their huge discounts over the holidays, kind of edge Target out because Target didn't really have a huge sale. They're always cheap and they couldn't go that much lower, but the stores in the mall started matching them price-wise. So they'd all rather be at Mandy and places like that, getting a half price sale than going to Target. That hurt Target in the winter. Just like the grocery stores, when the price of vegetables got so expensive, fruits and vegetables got so expensive for a while that Whole Foods wasn't much more expensive than a grocery store. Then the grocery store started getting their ass kicked by Whole Foods because they didn't have that price advantage. Whole Foods absolutely have a quality advantage. So if they have a quality advantage and you don't have a price advantage, you can get screwed really fast. These are cycles you got to pay attention to. But anyway, so when Target was up here and we sold the 75 calls, they were in the money, and I said, wait, but we bought back our puts expecting the downturn. We did get the downturn, so we don't have any short puts other than the 2019s, which we're not worried about. And again, value. I think this is what Target's worth. Okay, see this all the way down here? This is what Target's worth. I don't mind owning Target at $65. Okay, if they go lower, I'm not going to do anything about 2019 puts. If they get a sign, they get a sign, but probably they'll just go back up and they'll evaporate eventually. But this is what Target is worth. So on the other hand, though, I'm not going to sell calls on Target because I think it should do better than this. I think this is an overreaction. All right, we'll have to look at the actual numbers. But I don't believe that Target is so bad that it should be back at 65. So what did they do? Target. Oh, they warned. They didn't even announce. They just warned. Same store sales 1.3% from a year earlier. Online sales were up though. Total sales declined 4.9%, reflecting December 2015 pharmacy and clinic business. Signature categories, babies and kids and wellness outperformed. Electronics and entertainment. Okay, here's what I care about. Adjusted earnings are expected to be 145 to 155 versus. All right. So adjusted earnings are 145 to 155 versus 155 to 175. So let's call the middle 165, and now the middle is 150. So 10% guide down. Analysts expected a 9% increase. There's a 10% guide down here. The full year adjusted EPS, $5, down from $5.20. Okay? Last year, Target was in the 70s. Now it's 65. earning $5 a share. And again, now we go back to the same thing. It's there's a certain consistency to what we talk about, right? They earn $5 a share. You know, when you buy a company, stock, it's $65 and it's earning $5 a share, then your PE is 13. So it's returning roughly 7%, or 7.5%. So it's returning basically 7.5% on your money. It's way better than a bond, way better than a bet. It's a good value. So where's the floor? Well, if they're making $5 a share, they're not going to go below 50. They're probably not going to go below 60, which is a PE of 12, because you look at anybody else in the industry and retailers, and they're not at PEs of 12. And Target's a solid business. Okay, they didn't have the right mix this year. They didn't do the right discounting thing. They're this and that, blah, 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 whatever. Okay, everybody goes in and out of fashion and in and out of season. There's no catastrophe at Target. They're not going to zero or anything like that. Okay, they just need to figure out what they did wrong this quarter, this Christmas, and go back next year and do a better job. Look at this one. Look how horrendous they were here, and all of a sudden they exploded because they had a little better than expected earnings here, and they went from 54 to 79. Why? Because it's very easy for them to have a PE of 20. A PE of 20 is 100. So in a favorable market, they could go to a PE of 20. In an unfavorable market, a PE of 10. That's a range of 50 to 100, depending. But right now, the PE is about 13. So it's in the lower end of the range for where we'd expect PEs to be on a department store. 15, that's about right. So 15 is back to 75. So what's my value for Target? My value for Target is somewhere in the, since they just had bad news, they're probably going to go down to below 65, but I think they should stay around 62.50 or so, and up to 75. So obviously, we still love them in the butterfly, but that's exactly what we want the butterfly to do, go up and down the range. That's what we want them to do, because we want to sell puts when they're down here, and we want to sell calls when they're up here. So what are we going to do right now? We are going to sell the puts. We'll see what happens the next couple of days, but we're going to want to sell some puts. Short-term puts. We already have long-term puts. We'll sell some short-term puts, and then we'll wait for the bounce to sell some calls. And that's how we'll play it. So what strikes do we sell? Like I said, we'll just sell the puts. The 1552. That's right. It isn't that. No, I'm not sure. Sorry. Actually, I should look at short and see what's going on. Nothing's going on. Oil down here 52. Gasoline 155. Dollar, very important. Dollar's kind of punching back up to 101. If dollar goes over 101, these guys are all going down. We'll see what happens there. Gold selling off. Silver selling off a bit. Apple still 120, very good. Not good for our NASDAQ short, but generally a good thing. Okay, so now we can look at the closer chart. See, the consolidation, this is bullshit, and the consolidation is really down here. Oh, the beige book, damn it. Let's go look at the beige book. But it looks kind of weak. So to me, it looks weak, and it looks like it's coming down. It doesn't look like it's going up. It came down here. It's consolidating down on this line, and it's probably looking to punch lower. Now we got to find the beige book and see what they say. Oh, okay. Now, oh wow, why is it so short? Oh, it's not. They did something new. Highlight. Oh, they didn't used to have that. Okay. All right, reports from 12 districts. Now, I always read these reports. I look at like the bullshit. I try to figure out the bullshit language. keep in mind there are 12 districts. So when they say mixed and some and so on and so forth, you have to listen to what they actually mean. 12 districts. Economic continues to expand, modest pace, most regions, manufacturers. Oh, this is on or before January 9th. Very important to know what your time frame is. So January 9th. Also, by the way, you have to understand on the Beige Book, all this is the Fed governors in each region, or their staff, obviously. They pick up the phone and they call their buddies in the local manufacturers. You know, all the people who own businesses locally in their region. They call them and say, how are things going? They have a little, survey, checklist, blah, 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 but they're having conversations with these guys who own these companies in their districts, and they're just basically conversations. This is all anecdotal. There's no real numbers here. There's no nothing. They say to the auto guy, hey, how's the car sales going? Oh, yeah, we're doing really good. Okay, great, thanks. Next, they check something off. That's what this report is. It's incredibly vague and unreliable. Let's put it that way. All right. Manufacturers in most districts, and then they attempt to put spin on it, which makes it much worse. Manufacturers in most districts reported increased sales with several citing turnarounds versus earlier 16. Now, here's the thing. The market is at record highs. When the market's at record highs, I don't want it to say several people are citing a turnaround versus 16. Most districts reported increased sales with several citing a turnaround. I want to see all of them. Most, all but one, all but a couple, not some, not several. Growth in the energy industry is mixed. Why is the growth in the energy industry mixed on January 9th? Look at energy. Okay, so how is it that since the election, 42 to 55, that's 25%, or more, 30%. How is it that getting their report right here, they're able to say growth in the energy industry was mixed? What the hell is wrong with the energy industry? What do they need to get unmixed? 2 districts reported weakness in coal production. Well, we know coal is dead. Other reported improvements in coal. Well, oil or, others reported improvement in coal, oil, or gas. I guess they're not sure what the guy said. They look it back over. They probably say to the guy, well, did you say it was the coal or the oil or the gas? And they're like, well, I don't know. You said things are better. So they're not quite sure, and they didn't bother calling the guy back to find out specifically. Non-auto retail sales expanded. Therefore, auto retail sales have not expanded. Several noted sales over the holiday season were disappointing. We've seen that a lot. Again, record market highs. Several noted sales over the holiday season were disappointing. Reports in more than one district, more than one, that's 2 at least, suggest the growth in e-commerce would come at the expense of brick and mortar. Well, all districts reported varying degrees of growth in employment. All districts reported varying degrees of growth in employment. Wow. All families reported varying numbers of children. Amazing. Wow. This is some report. I'm trying to describe the labor market as tight. There you go. That's better. A majority, so we have tight labor markets. We finally got to a fact in this report. Residential construction and sales were generally mixed. Okay, again, nothing. They said nothing. Although San Francisco had strong real estate activity throughout the 12th district. Okay. Financial conditions were stable. Firms across the country and industries are said to be optimistic about growth. Now, again, this is the Trumpism. You have to realize that the people who own companies are, for the majority, Republicans. They're happy Trump won. They think that things are going to be great, and they're optimistic. We already know that, right? That's what caused the market to go up so much. Labor markets tight or tightening. Employment growth range from slight to moderate. That's not good. Most districts indicated wages increased modestly. That's good, except not so much for the people paying the wages. A couple of districts mentioned layoffs, but even those districts, most regions, most firms were said to have added employment on net. District reports cited widespread difficulties finding workers. Several also noted problems recruiting less skilled jobs, wages. Wait till you get rid of all the immigrants, then you're going to have real problems. Wages in some districts were pushed up a bit by increasing the state's minimum wages. Yeah. Even though we're having a hard time finding workers, and even though we're having a hard time filling jobs, the only reason we're raising wages is because the states are mandating it. Really awful. Poor workers. Many districts, don't be a worker. Many districts said contracts expect their labor market to continue to tighten in 2017. I told my kids that already. Do not plan to go to school to learn how to be a worker. It's just a lifetime of misery. Many districts said contracts expect labor markets to continue to tighten in 2017. Wage pressures likely rise. Price of hiring steadier increase. Okay. Now, the Fed cares very much about this. The Fed does not like wage pressures. You know, when the Fed says that their job is to maintain price stability, they really mean wage stability. That's like their number one goal, is to make sure wages don't go up. They'll mess around with the market to keep wages low. That's their main goal of doing this. Pricing pressures intensified somewhat, and they've done a phenomenal job for the last 40 years, I got to tell you. Pricing pressures intensified somewhat since the last report. 8 out of 12 saw modest price increases. This is called stagflation. Stagnant wages, but inflation, stagflation. 8 of 12 districts, there's an actual number, 8 of 12 districts saw modest price increases, and the remainder experienced slight increases. That means nobody didn't see an increase. Oh, or flat. Sorry, Atlanta flat. Okay. Input costs were more widespread than increases in final goods. So the cost of goods produced are going up faster than they can pass them on to the consumer. This is important to know, right? That's going to be something we'll look to see reflected in the earnings report. Cost increases reported for coal, natural gas, selected building, manufacturing, retail selling prices were mixed, with on-balance were flat or down against competitive discounting, holiday discounting. We talked about that. Prices on most agricultural commodities stayed flat at very low levels. Home prices were stable or up modestly. Businesses in several districts reported expected further increases in input costs for selling in 2017. Okay. Ooh, I can make that bigger. Sorry. Okay. Economic activity in the first district expanded moderate pace. Okay, I don't really want to read every individual report, frankly. Summary of economic activity. Wait. Oh no. How weird. Oh, they've really changed the way they do this report. They did not. Wow. They made a very, very small general thing, and now they've broken down every region. Bad report. Wow. Okay. In other beige books, they go through everything and talk about the generalities of regions. Here they haven't. I think the reason is because generally this is not good news. I guess we'll test it. Economic activity in New York is held steady. Labor markets tight. Wages continue. It's just repeating the old thing stuff. Input costs increasingly widespread. Selling prices increase faster pace. Housing market weakened at the high end. Commercial real estate markets have slackened. Okay, this is bullshit. All right. I believe this is not a particularly good report. See all this stuff, retail and tourism, manufacturing, blah, blah, blah. They used to do one combined one for everybody and talk about most districts, some districts, like they did in the other one. Now they've skipped that, and they're just talking about each individual district. Makes it way harder to read the report. All right, but economic activity. Let's just do the summaries of economic activity. Economic activity expanded in the first district in Boston. Both retail manufacturers modest to moderate increases in revenues recent weeks. Software information, commercial real estate were mostly steady. Residential real estate across the region continued to experience increases. None saw substantial. Number of firms. Difficult hiring. Prices largely stable. Most firms positive outlook expecting growth. Okay. So Boston's pretty good. New York. Steady. Labor markets tight. There have been increasingly widespread increases in input costs. Scattered sign of pickup in selling prices. They're having problems pushing pricing through. Manufacturers indicated business rebounded following an autumn slump. Service sector contacts modestly expanding. Consumer spending has been mixed, not good, even as consumer confidence climbs. So spending is not showing what the confidence says. Housing market's mixed. Weakness at the high end. Commercial real estate is slack. That's not good. Residential construction sluggish. There has been some pickup in office and industrial construction. The bank reported both loan demand and delinquency rates are steady. Moving on to Philadelphia. Modest pace, a bit faster than the prior period. Notable shifts included non-financial services, improved to moderate, four sectors, non-auto consumer spending, manufacturing, and non-residential construction leasing improved to a modest pace of growth. Again, modest pace of growth is not what you want to hear in record market highs. Employment growth also steady pace, pickup manufacturing firms. So the pickup included manufacturing firms which had been reporting losses for much of the year. So they're picking up but from really bad comps. Wages rose modestly, labor market tightened, general prices continue to grow, firms continue to expect moderate growth. So this is not booming stuff. Cleveland, economic activity grew slightly on balance. Slightly on balance is not that great. We're skipping along with these things. Richmond, economic grew moderately faster since the previous beige book. Reports were strongly upbeat in December, while assessments reported later in the month were more restrained. So early December good, then it fell off, which is what we saw in retail. Demand for labor increased moderate. Price changes generally mild. Prices received at a higher pace. The manufacturing sector strengthened. Producers indicate growth in new orders. Retail sales rose briskly, while tourism at winter resorts strengthened to seasonal levels. Residential real estate activity will change. Commercial real estate leasing rose moderately. Residential construction loans flat, slightly stronger. Revenue and non-financial services modest. Indicators of agriculture and research were mixed. You know, it's an okay report, but not for record high markets. Atlanta. Economic activity expanded at a modest pace. Expanded at a modest pace since the previous report. Okay. So nothing exciting there. Chicago. Economic activity, modest pace. They expect it to move up at a moderate pace. Wow, okay. Those contacts expected it to move up in the next 6 to 12. Nobody's expecting this gangbuster market that's already priced in, you know. St. Louis. Contacts suggest economic conditions continue to expand at a modest pace. Land activity, generally positive. Labor markets remain tight. Moderate growth. Consumer spending unchanged. Expectations of improvement. Real estate conditions were mixed. Commercial activity robust. Ooh, robust in St. Louis. District bankers loan demand remains modest, with growth modest among loan types. Oh, what did I just do? Minneapolis, modestly overall. Boy, there's a lot of districts, huh? Kansas City, modestly. See, modest and record market highs just don't go together. People are optimistic about growth. They think it's going to get better, but it's not actually better now. And again, that's the problem with anecdotal surveys, because you don't really get a good picture. Economic activity in 11 districts expanded moderately again. Manufacturing activity increased. Demand for non-financial service strengthened. Dallas should be doing great because of oil. Retail automobile sales rose. Some reports of weakness. Housing demand grew. Commercial leasing expanded. Here's a better report. Loan demand was stable. Energy sector further improvement. Agricultural faced mixed conditions. Record grain pressured prices. Firm demand. Prices, employment, wages increased. Outlook generally improved. That's a good report. If all the reports were like that, I would be a little bit more bullish. But that, of course, is because they're very energy concentrated. All right, San Francisco, where all the money is. Economic activity continued to expand moderate pace. Inflation modest, wage pressure strengthened, sales of retail goods picked up, consumer business sector strong, manufacturing little change, strong activity in real estate. Yeah, they're sold out in real estate. Conditions in commercial strength and lending activity grew. Okay, so San Francisco also a pretty strong area. And that's it. All right, so you have two really strong areas, and everybody else is like, eh. And that's 10 out of 12, like not that exciting. All right. So, Okay. So on the whole, beige was not that incredibly exciting, and let's see what our friends at the Wall Street Journal thought of it. It doesn't matter what I think, it matters what the press thinks, right? Even though I am kind of the press. Inflation gauge top 2% supporting Fed's plan to raise rates. There's no mention of the beige book, but it didn't happen. That's interesting, huh? Nope. Okay, well, it doesn't read a mention in the Wall Street Journal. That's interesting. But the markets are taking, well, we missed the 52 fell. We missed it. So there's your real indicators. The oil markets don't see it as very exciting. And we lost 52. But the NASDAQ is moving back up. Nothing really telling here. A little up here, a little up here. Nothing too exciting going on. Oh, I wanted to play that one. We wanted to play the bounce off 1350. I forgot. This is interesting. I wonder how low they can end up going on oil. And look at poor gasoline. Bad. Hopefully natural gas will come down and we'll get a nice play on that one later. I have to go on TV later and talk about all this stuff too. I really get my head together for that. On BNN, that's the Canadian version of Bloomberg, on 7 o'clock on Money Talk tonight. All right, so the whole lot of nothing from the beige book, unfortunately. It's a good thing we didn't go long on TL. Can you explain the SunPower trade, please? Explain the SunPower trade. Oh, dear. What does that mean? Explain the SunPower trade. Okay. Well, here's the SunPower trade. We bought the $5 calls back in November. We sold the $10 puts, and then we sold more $10 puts. So the trade was, we didn't think it was going to go much below, well, it's not that we don't think it's going to go below 10. This was an aggressive sale. We got $3 for the $10 put, so we didn't think it was going to go below 7. Here we got $4. A month later, we got $4 for the $10 put. So our average price on these is like $3.45. So that means that we are net into this thing for $6.55 on the short puts. On the call side, now those puts we collected quite a lot of money on. We collected almost $7,000 on them. We only spent $3,300 on the call, so we have a $4,000 total credit on the spread. We have these $5 calls, even though they're about even right now. They didn't cost us nothing because we sold all these puts. So basically, as long as SunPower is over their $4,000 credit, so we need this to be over 8. Basically 8. No, but then 8 would pay us $3,000 back here. 7. Okay. Basically anything over 7 on SunPower. The way this is set up, anything over 7 we make money. That's pretty much the way it's set up right now. So anything over $7, this is profitable. And this one, these guys have until 2019, and these guys are here. Now, China, of course, is doing a big solar stimulus thing, so we like that. In fact, we added CSIQ because of that. STWR. So we basically think SunPower is pretty much bottomed out here, and we're just long-term holders of it. It's not complicated. All right. So during a market correction, using the butterfly list to reload more long-term stock is a plan. Well, Yeah. I mean, any of those butterfly plays, we generally like them value-wise where they are. So if it goes below those prices, so yes to the fact that we want to be long on it. With my Apple, with your Apple, with Apple, where do you think it will pull back to with earnings? I'm still trying to leg into the 2019 Deathly Calls Bear. Wow, this is a long time to work on something. Let's see. Well, you say will it pull back? It may not pull back. It may just go flying up. So be careful. API. I mean, Apple is the greatest stock on the planet. I still say that. I still can't think of any stock. If I had to own one stock, it would still be Apple. And again, I mean, you talk about guys who make money. They got I think a $600 billion market cap. It's getting no respect. Market cap. Oh, here. Yeah, they got a $600 billion market cap. They got $250 billion in cash. So technically, their market cap is more like $400 billion. Okay? Because they got $200 billion in cash. They're doing $200 billion in revenue. They're dropping $50 billion to the bottom line, which gives them a PE of 8 after cash. They don't really have any debt. They've got the number one selling consumer product on the planet, and plenty of room to expand with home systems, TVs, cars, things like that. The problem is traders, not investors, traders, and they pay a 2% dividend. Traders are ridiculously impatient. They're just like freaking infants. And if Apple doesn't come out with a brand new something every year, they think the company is dead. But that's not how it works. Steve Jobs didn't invent the iPhone in February and bring it to market in June. They worked on the iPhone for 3-4 years before they rolled it out. Okay, the iPod was not the iPod. The original iPod was an iPod. That was just a music player. But when they came out with the iPod with the screen, that was the end of the iPhone. That was years before the iPhone came out. They were testing some of the features of an iPhone without letting people know what they were doing. But if you look at the iPod that looked like an iPhone, they basically were iPhone. And in fact, and then they had the iPod and they had the iPod Touch, the touch screen. That was the iPhone. The iPod Touch was basically an iPhone without the phone. It took them another couple of years to figure out how to get all the little tiny phone bits inside that stupid iPod case. But the case, the thing, the buttons, the icons, everything was the same. But it took years of work and testing and putting it into consumers' hands and so on and so forth to come out with this suddenly revolutionary product. So to expect them to do that every year is ridiculous. Okay, you may as well expect Santa Claus to come out of the sky and drop presents on you. It's not how it works. Lockheed Martin is right now working on nuclear fusion, and they say it'll be ready in 10 years. They're not lying. That's how long it takes. They got a pretty good idea of where they're at, and between here and actually producing a workable unit, it's going to take them 10 years, even though they know exactly what they want to do. Because they know that they have to refine this and refine that. With Apple, they had to come out with a better antenna and a better battery and this and that. And they said, well, if we work on batteries for this long, just like Tesla's doing, people take their word for it, but they don't take Apple's word for it. You know, like Tesla says, okay, we need a better battery with a better range that's cheaper, and therefore we're going to do this, and that, and it'll take us until 2018 to do it, and then we can put it in this car and charge this much for the car. That's what Apple has to do, too. They have to come out with a better amount of memory. Otherwise, you can't watch movies on your phone. They have to come out with a faster processor that doesn't have as much heat so the phone doesn't melt your hand or blow up like Samsung's did. Why? Because Samsung skipped a step. Samsung was so eager to copy Apple that they went for the fastest processor without speed testing it, basically. It's hard to do. It's hard to make all those parts work together safely in a phone, and safely and not take up too much battery time and not burn out too fast and not do this and that and not crack too easily when you drop it. So it's a lot of bits. And it takes a long time to do this stuff. And to expect Apple to say Apple, who they came out with the iPhone and they came out with the iPad, which really was a big iPhone. They came out with a watch, which is obviously in early stages. Now they're going to come out with glasses, which Google already blew that market, so I don't know if that's going to do any good. Everybody else has these stupid, the Amazon Echo and things like that. I'm sure Apple's going to come out with something like that, but hopefully working better. Although frankly, I'm amazed Apple Pay isn't more popular. I don't know how many of you guys use Apple Pay, but it's my favorite way to pay for things. You freaking hold your phone. Instead of taking out your credit card, you take out your phone, which is easier than taking out your credit card mostly. You put your phone by the same screen where you run the same screen where you have to wipe your card, right? You put your phone, touch it to the screen, basically. Then just above the screen. You touch it right there. A picture of your credit card comes up on your phone. You push your thumb on the thumbprint thing to identify yourself, and it's done. No signature, no nothing. You just walk away. And if you want the receipt, go straight to your phone. And it tracks every single purchase you make, so you can't buy anything without knowing exactly what it is. I don't know why anybody wants to do anything else, but surprisingly, I'd say 75-80% of the places I go don't take it. It's weird. So Apple, to me, they should be working on that more because they should be. I don't know why anybody would not want to use your phone to buy things. It makes no sense to me. I mean, frankly, at this point, I really don't see why I have to carry a wallet at all. I mean, if I could somehow use my phone to be my identity too, I think that's pretty much all you need. Where were we? Okay, so Apple. Sorry. So still the greatest consumer product company in the world. I mean, they speculate the iPhone 8 this and this and that. It's the 10th anniversary of the iPhone. Everyone's expecting something exciting. But there's so many ways they can go. And so many more things that they can still do, just expanding on what they have. But it's going to be more than that because they're going to be in the car spaces. That they're going to be in the in homes as you get a more integrated home environments and smart appliances and so on and so forth. And when you think about smart appliances, think about an Apple fridge and an Apple stove and an Apple. Think about all the different things that they can come out with that all work together in peace and harmony in your house. The opportunity is there for them to double, triple, quadruple in size. But I certainly wouldn't bet against them. And I still, like I said, I think if I had to have one stock, I would be happier to have Apple be my only stock for the next 10 years and 20 years than pretty much any other stock on the market. Because I don't see why they would not continue to innovate and grow over time. But anyway, so don't look for a pullback just because you want a pullback, okay? If earnings are good and earnings. Oh, here you go, January 31st. So if earnings are good on January 31st, they should go to 130. I think 130 was a target of ours at one point. So they're at 120, which is fine. But I think 130, and I think, frankly, next year we could be seeing 150 from these guys into 2019. Would you suggest riding out the short 30 call with SCO now at 34.50? What for 2 days? Yeah, I wouldn't buy it for no reason. I mean, I would rather take the chance than buy it out. Although, if oil seriously is crashing now, but it's not. See, it's holding 52-ish. I mean, I wouldn't really expect it to go much further. I don't know if I call it a coin flip, but given it's Friday, given tomorrow's Thursday, unless there's a really bad inventory report, which will come out about 11 o'clock tomorrow, I think they'll manage to hold like 52 into the weekend. But I just think there's going to be a bit of a downward grind over time, like into next month. PSO selling in June, $7.54. Isn't there a chance of assignment and owning a declining stock? Of course there is. I'm just saying. I think that if they're earning $1 a share, which is what they just said they were doing, even after guiding down, then I don't mind paying $6.50 for a stock that's earning $1 a share. And again, you're talking about price. I don't care about the price. If they're earning $1 a share, I don't mind but paying $6.50 for it. That's all I care about. How much does it cost me to get $1 a share? That's what they earn. It shows up eventually. Any interest in a trade on XLF, only to short them. I think that's way overpriced for that financial. And we already have a FAS play that we're short. Well, yeah, so I mean, I think, again, you can see from what's been going on with the financials, they're putting up good numbers, but they're just not good enough to support this. This is crazy. Okay, look, all the people trading financials were pretty sure that 19 was the correct price, all the way along for 2 years. All of a sudden, Trump gets elected, and we go to 24, 20% higher. All these people, what's more likely, that all these people were 20% wrong, or that these people are 20% wrong? Okay, somewhere in between is the truth. I think obviously Trump is good for financials, and here you have a problem because it's such a severe move up that you've actually moved the 200-day moving average up, much higher than it was. But even so, the 200 days to 20, you're at 22 here. I think somewhere maybe 21 is more like the right price, 10% higher, maybe 22, 10% higher than it was the most, I would say. Yeah, Trump's in, less regulation, less taxes, but it doesn't change the fact that the Fed has to tighten. Not necessarily good for the financials for the next couple of years. So I think this is just overdone. But do I care about shorting XLF from 23 to 22? No. It's not to me. It's not an interesting play. I do think it's going down though, and we do have a play on FAS where we have a bet that it's going down. But that's just something left over from the previous trade. Okay. So something's happening at 3. Oh, Yellen's talking at 3. That's right. Take a quick look at our portfolios. Here's the options opportunity portfolio, 144%. I'm not going to go over the positions. TZA, oh man. Well, luckily the market's not down, so I meant to add officially the SQQ hedge from this morning. I had to officially announce it over on the Seeking Alpha site, but we are doing that for my morning post today. We're doing this SQQ spread. Not that one, this one. It's an official play for the options opportunity portfolio. So what's that? We got TZA. We have this USO that's it's July, so we don't really care. It's a bullish play on USO for July, and it's already in the money, so we just expect it to go a bit higher in July. We have this SQQ March spread. That's working out okay. Because it's split. I have to figure it out with the split now. That's why they show funny numbers. We have split. Here's Frontier, who we love at this price. Do we love enough to buy more? We got 2,000. I think that's good. Apple, ABX, CSIQ is a pretty new one. That's solar, still a good price. Disney, somebody just really downgrade on Disney. I don't agree with them at Didn't affect the stocks today either. Kate Spade, Macy's, yeah. I'll do a proper review later. Anyway, we're in really good shape here. We're at 243,000, it's up 143%. We have 168,000 in cash. So 168,000 in cash. We have 75,000 in positions. That's our portfolio. So we don't have a huge amount of risk. We have plenty of cash on the side. I still, though, want to add that SQQ to be a little bit safer. Then we go to butterflies we looked at already. That's another easy one. Butterflies are up 235%. Again, look at the cash in butterflies. we have 310,000 in cash out of 335. Only 24,000 of our cash is tied up in positions. So that's a real, barely cash, but a lot of margin, 200,000 in margin. So out of, basically about $600,000 worth of margin that we have in this portfolio, we're using about a third of our margin. Because they are margin, they're I wouldn't say margin intensive, but we use a good deal of margin in the nature of the positions is to do that because we sell a lot of premium. But surprisingly, there's only 12 spreads, and Valero, Walmart, and Microsoft, Microsoft, and Valero. So all these other positions are parts of other positions down here. This whole portfolio is 12 positions, and it's making 80% a year. So simple, so easy to follow, and yet too boring to talk about. Just we touch it so little. The short-term portfolio cannot get out of this rut. It's at 360%, which is fine, but it's been at 360% for ages. Another one. This one has more cash than it's worth. So it's $459,000 value portfolio. $462,000 is in cash because we sell a lot of premiums on this one. This one is very margin intensive. Now, again, the short-term portfolio is paired with the long-term portfolio, so we have much more margin than it looks like because it's a paired portfolio, and the long-term portfolio is sitting on tons of margin. This is just hedges mostly. Not much of a position. We have bullish here on ABX. We have the bear spread on Netflix. We have the coffee play. But most of the portfolio is really these 100 TZA hedges and a bunch of SQQQs also somewhere. I thought I had SQQQ. What happened? Am I crazy? What happened to SQQQ? Oh, there it is. I knew we had something. And we have these SQQQs, which also have to be adjusted because of the split. Oh, so that means the portfolio is doing better than it looks because we got a 0 for the SQQQs because we didn't do the split adjustment. So we are penalized at the moment. So it's actually not as bad as it looks at 360. Not that 360% is bad, but you just kind of think it should be better. Long-term portfolio cranking along 142% out of 1.2 million in position. Well, we have 1.2 million value. 900,000 here is cash, so 75% cash in the long-term portfolio. Here we're using relatively well. It's 1.2 million. We're using about half of our margin in the long-term portfolio. And the reason for that is all these short puts, which is how we enter our positions when they're new. And it wouldn't be the dividend stocks, and it wouldn't be too many of these. Some of these we have naked calls and so on and so forth, but not much. And the long-term portfolio, we've got 23 spreads. We have 9 dividend positions. That's 32. And then we have the short put. So this is the most positions, of course. And this is hedged by the short-term portfolio. The purpose of the short-term portfolio is to hedge the long-term portfolio. That's what it does. We don't really like to go into the long-term portfolio and do stuff if we don't have to. It's like the butterfly. It's like monthly changes at most. Really quarterly. We really try to stick to like quarterly changes. Unfortunately, though, This is January. We have a lot of work to do in the next 2 days on these portfolios. There'll be a lot of position changes. But on the whole, everyone's doing great. We're like way up from the last review, which was only a couple of weeks ago. And it's so tempting to just cash out and get out of this stupid thing. I don't see how we're going to keep everything. I don't see how we're going to not lose money in a pullback, even with the hedges, if there's a severe pullback. I think it's going to drop, could drop 5-10% in our value, which is a lot of money. We go to cash, we avoid that. But on the other hand, I felt like going to cash in September, and we would have missed 20% gain. So I guess you kind of have to consider the gains. If we give back 10% out of the 20% we gained in September, what's the big deal, right? Better than missing. See, here's the lesson I learned in 1999. Better to stay in, or at least stay in and be well hedged on the way up, so you get something on the way up, than to just get out and then watch the market go up and up and up and get away from you. Because we don't know. They could swear Trump in on Friday and the market could blast up again 10%. We don't know. And it'll suck if we're not in these positions and they start going up like crazy. And then we have a choice. You're sitting in your cash and you have to decide to either pay a ridiculous amount of money for stock that you sold a while ago, or just wait for a pullback that doesn't come for another 6 months. Those are both nasty choices. So tempting as it is to go back to cash, there's reasons not to. And also, like I said, though, I think we'll learn more going through a pullback and managing the pullback with our positions rather than just going to cash. You don't learn much going to cash other than saying, boy, that was good timing. So I will do my best. There may be a point still where I call for cash because, when the market does start falling apart, you want to cash out. That's the point. The reason you have a hedge is not to say so you never cash out. The reason you have the hedges is to, on the way down, it lets you not panic out of positions. You can stick with things longer because you're making money on one side while you're losing on the other. You stay relatively even, which lets you pick your spots to cash out instead of panicking out of everything you have. That's like the worst things happen. When are you putting? When are you? Today, now. I should have done it earlier. I forgot. That's all. Yes, QQ was meant to be in the options opportunity portfolio as of this morning. All right, so we have 10 minutes until Yellen says whatever Yellen's going to say. Now, let's be realistic. What is Yellen going to say? Is Yellen going to say, I've changed my mind and I think that we should have a much tighter policy than we previously indicated, ignore all those other guys, and forget what we said in the last meeting, but now I'm going to tell everybody something different? No, that's not going to happen. He's going to say something that's generally dovish, and the markets will probably go up. And the question will be, how much will they go up? Because she may say that, but now then we have to worry about Trump being sworn in 2 days. At noon on Friday, so we have less than 48 hours until Donald Trump will be the president of the United States of America. He will be given the nuclear football. He will be given the codes. He will be handed the veto pens and all the other stuff that you get when you're president. Not really that much stuff, actually. It's really not much. Other than that, other than the nuclear codes, it's really not that exciting, I imagine. But he will get access to the war room and access to all the generals, and everybody will now report to him. And the defense of this nation, the health of your children, the safety of the citizens of the United States of America, the future of our country will rest in the hands of Donald Trump. You voted for it. And if you didn't vote for him, you still voted for it because you didn't work hard enough to get Hillary elected. So this is your fault. Enjoy it. I can't even believe this is happening. All right. Anyway, look at the dollar coming up to 101. So anyway, it's going to be interesting. Pretty much guarantee that. If I was going to take a bet right now ahead of Yellen, I would bet the Russell at 150. But it's honestly, what if she doesn't say something dovish enough? What if what she says comes off wrong? You know, who the frick knows? Let me see what she's even supposed to be saying. That's a good question. What is she actually doing? We read the beige book. We got a very muted, not a very good reaction to the beige book. So now the question is, who are you speaking to? That's my question. Speech Yellen. Goals of monetary policy and how we pursue them in San Francisco. So she's having a lunch thing. It's noon over there. So she's having a lunch conference in San Francisco, talking to, I don't know who the Commonwealth Club is, but obviously these are rich people in Silicon Valley. And goals of monetary policy and how we pursue them. So it's not the kind of thing where she's going to be giving an outlook. Here, she's at Stanford, and she's got, this is tomorrow at night, she's got another speech where the economic outlook and conduct of monetary policy. So that's one where a little bit more of a broader reaching thing, and she's probably going to say something. The Federal Reserve Board will be closed in observance of Inauguration Day. They'll publish something, statistical release is scheduled, blah, blah, blah. Interesting. Okay. This is a Fed calendar. That's what this is. You realize it's a Fed calendar. So there's not much that's going to happen here. So anyway, so trading-wise, it's a 50-50 event. I mean, I think it's not likely she'll say anything. Let me see if I can do this. All right. It's not likely she'll say anything bad, and it's not likely that she's going to move the markets harshly with what she says. Therefore, the Russell, betting the Russell up is probably a good bet. Now, did she release the notes? Is her speech released? That's a good question. Watch it live. See what it says here. The Commonwealth Club of California. Oh, so it's like a Facebook Live thing. Well, there she is. No, that's not her. So obviously there's no pre-release copy of her speech. All right, so anyway, so back to what we were talking about. So if we were going to play anything, I would play this guy long, Russell. It's a good spot at 1350. If it fails, and you get out quickly. So while we're waiting for Yellen to get started, well, unfortunately, a little slow on the trigger. They were really 1351. So oil's bouncing back to 52. Gasoline's bouncing back to 155. That's not a bad play either. It's playing gasoline at 155 into the weekend. So what do we think? Do we want to play that? I mean, I don't really want to pay dollars. I don't want to pay 1.5 more than I wanted to. That's why I'm not clicking on it. I'm not really thrilled with even paying 1 point extra. But statistically, that's the play I like. So we'll just keep an eye on it, see what happens, and we'll wait a few minutes and see what Yellen has to say in 5 minutes. But again, in 5 minutes, if her speech isn't pre-printed, it's tedious to sit here and listen and hear what she actually talks about. And Obama's talking right now anyway, so I feel old Trump yelling, so to speak. We'll see what happens. Trump land, do that. Yeah. This is just what we need. So we will see what happens. I don't know. I'm not. What's Obama even talking about? His final news conference. Status quo in Israel is not sustainable. Okay, great. He just figured that out, huh? You know, I've been president for 8 years, and this situation in the Middle East is not good. We need to be better than that, right, with our president? All right, so let's see. What else is going on? The rest of it. I don't have any questions. I'm killing some time while we wait for Yellen to show up. You're below support 2 here, but oil's coming back. The dollar's getting stronger, though. It's a little weird. If the dollar starts going up, that's going to put pressure on. Although you could say they've actually made a kind of a good move, considering the dollar's been rising since 11. So here, while the dollar rose, it went down. But now that the dollar kind of slowed down, it's regaining footing. So it has been, to some extent, this dollar pressure that's been pushing oil down. And it's not a small move. It's from 100.50 to 101. So it's a 0.5% move, and you're getting a 50-cent move in oil, which makes perfect sense. And obviously gasoline, the same thing. So I think to a large extent that really is explaining what's going on here. Here's 52 on the button on oil. But if the dollar punches through, I'm not sure if they can even sustain where they are. They're very tricky. Russell's still kicking up a little bit. And, you know, by the way, sometimes in the market, if they're waiting for Yellen to say whatever she's saying, sometimes it's not really about that, and they're just going to use it as an excuse to, you know, rip the market one way or the other. But again, I don't see much of a case being made for a sell-off at this point. I think if anything, we might go back a bit higher. And now we're going to hit one. We're going to hit 1352. So mad. Oh well. Can't trade them all, right, kids? Actually, you know, if the dollar's getting stronger, you got the Nikkei's nice and low. That could be an interesting trade too. I think if the Nikkei goes back over, well, it's way away from 19. If the Nikkei goes back over 19, that's a good one to play on the long side. But I'm waiting to see if this guy comes over 101. Oil's just over 52 at 52.01. And the NYMEX is closed. It closed at 235. That's another thing. We bottomed out at the close of the NYMEX at 230. And now that the NYMEX is closed, oil is creeping back up. So on much lower volume. And that still has to do with them still cycling out of this front month contract they got to get rid of. On the whole, so let's see. So Yellen's going to say something fairly easy. And the dollar is probably not going to go lower if it's already low. Markets, if they don't have any pressure from the dollar, they should go up. So I'm still in that camp. I still believe it's going up. Can't get out of it. My thought process. So here we are, 152.2. So I said poo-poo to that 6/10 of a point ago. It made $60. Not happy. $60 to pay for dinner, right? But anyway, so just an exercise in observation of the moment. Oh, look at that. And it's right about you're supposed to talk in 1 minute. get back to that Fed thing. Oh, here you go. Four, three, oh, it's counting down. Then what happened? Starting at 12 noon Pacific time. Oh, it's now, yeah, it's 12 noon. Oh, so all this is delayed. How annoying. Oh, Yellen says rates will creep higher, not rise dramatically. Wait a minute. Breaking news. Yellen expects 3% Fed funds rate by the end of 2019. 3%. So it's like 0.75 now. So they're talking, but she's talking about 2 point, okay, she's talking about a lot of hikes. She's talking about 8 hikes. That's not good. How's the market reaction to that? That's interesting. All right, well, now we know. No effect. If anything, a stronger dollar. I would say the dollar should get stronger from that and less enthusiastic about being long. She's talking about 3% by the end of 2019. That's 8 quarter-point hikes in the next 2 years. That's a faster rate of hiking than has been expected. That should strengthen the dollar. It should knock silver and gold down. So we're going to go back to 17 on silver probably. Natural gas might come a bit lower too. It should not be very good for oil or any of these or gasoline or anything else. And it's not particularly supportive of the indexes. So forget that trade. Forget the long here. I'm glad I'm not in it. And I'm certainly glad I didn't chase it like an idiot, which is what people do all the time. If you miss a trade, you miss a trade. Wait. Things happen like this. It's not hitting people's heads. They're not getting it. Maybe it's just that there weren't too many people who were aware of what happened. All right, anyway, so my prediction is that this is not bullish for the markets. We're not going to get a strong finish. We absolutely want to put that SQQQ trade on from this morning to the options opportunity portfolio. I'm not into shorting anything right now, but certainly I wouldn't want to go long based on that because that is a faster rate of rate hikes than people have been anticipating. Saying that she wants to be at 3% at the end of 2019 is a higher target by probably a half a point than most people are expecting. All right, so that's that for that, and we will end it there unless there's another question. Close to dual goes, can't get time in next site, gold is selling off. Yep, that's what's going to be happening. I don't think that's bullish at all for the market. We'll see what happens. Now it's all up to Trump to inspire the nation on Friday. Trump, let's look forward to it. All right, guys, see you again next week. Thanks.